Chapter 1: The Fateful Decision. September 15, 2008, 1:45 a.m. EST. The clock above the mahogany table in the Federal Reserve's emergency meeting room showed 1:45 a.m. 6 men sat in silence, their faces illuminated by the harsh fluorescent light that made even the healthiest complexion appear cadaverous. Treasury Secretary Henry Paulson's hands trembled slightly as he reached for his glass of water. The ice had long since melted, but no one had thought to refill it. "Gentlemen," Paulson began, his voice raspy from 18 straight hours of crisis meetings, "we stand at a precipice that rivals any in economic history. Lehman Brothers has requested federal intervention. The question before us is simple, yet its consequences will echo through generations. Do we save them, or do we let them fall?" The room felt smaller than it had that morning. Outside, Manhattan skyscrapers stood like silent sentinels, their illuminated windows creating a false constellation against the September darkness. But inside this chamber, the men who held the world's financial fate understood they were about to make a decision that would either plunge humanity into immediate chaos or set in motion a far more sinister timeline. Federal Reserve Chairman Ben Bernanke, his beard more silver than brown these past weeks, opened the leather folio before him. The documents within represented the cold mathematics of catastrophe. Lehman's balance sheet showed over $600 billion in assets, but their actual market value remained a mystery wrapped in derivatives so complex that even their creators no longer understood them. The overnight repo markets, the circulatory system of global finance, had already begun to seize. Credit default swap spreads on major financial institutions had exploded to levels that suggested imminent default. "Let me be perfectly clear about what we're discussing," Bernanke said, his academic precision struggling against the weight of the moment. "If we intervene, we signal to every major financial institution that they can take unlimited risk with the expectation of federal rescue. This is the very definition of moral hazard that Alan Greenspan warned about for decades. But if we allow Lehman to fail..." He didn't need to finish. The men around the table understood the interconnected nature of modern finance better than anyone on Earth. Lehman's bankruptcy would trigger cross-default provisions on hundreds of billions in derivatives. Their failure would force immediate write-downs across the global banking system. Money market funds, which had invested heavily in Lehman commercial paper, would break the buck, fall below the sacred $1 per share threshold that had defined them since their inception. "The Japanese experience haunts me," whispered Timothy Geithner, then president of the New York Federal Reserve. His voice was so low the others had to lean forward to hear. "When their asset bubble burst in 1990, they refused to let their zombie banks fail. They injected capital, provided liquidity, did everything we're contemplating. It bought them time, yes, but it also condemned them to what they now call their lost decade, though it stretched to 3 decades and counting." Paulson's eyes flicked to the Bloomberg terminal in the corner, where red numbers cascaded down the screen like digital blood. In Hong Kong, markets had already opened. The Nikkei was down 4%. European futures suggested openings that would make Black Monday of 1987 look like a minor market correction. "History teaches us a brutal lesson," Paulson continued, his voice gaining strength as he embraced the terrible logic of their situation. In the 1920s, Weimar Germany attempted to print their way out of crisis. By November 1923, a single American dollar traded for 4.2 trillion marks. People carried their wages in wheelbarrows. The middle class was annihilated. That economic chaos created the conditions for... He couldn't finish. They all knew what followed Weimar's hyperinflation, the rise of extremism, world war, the death of 60 million souls. "Consider the alternative timeline," Bernanke interjected, pulling their attention back to the mathematical reality before them. "We save Lehman. We establish the precedent that no systemically important institution will be allowed to fail. We maintain the illusion of stability, but we do so by transferring private risk to the public balance sheet. We socialize losses while allowing profits to remain private. We create an economy where the very concept of risk becomes meaningless. The silence stretched for nearly a minute. In that quiet, each man contemplated the weight of deciding which apocalypse to unleash upon the world. They understood, perhaps more clearly than any group of policymakers in history, that they were not choosing between salvation and destruction, but between immediate destruction and delayed, potentially greater destruction. "Gentlemen," Paulson finally said, his voice carrying the gravity of Solomon's judgment, "we have before us two paths. One leads through the valley of immediate fire, the purging flames of creative destruction that Schumpeter described. The other leads through a longer corridor where we postpone the reckoning but potentially make it worse through our delay. The question is not whether pain will come, but when, and in what magnitude." The digital clock on the wall clicked to 1:47 a.m. In 14 minutes, Asian markets would close. In 3 hours and 13 minutes, New York would open. The decision could wait no longer. "I propose we take the path of immediate pain," Paulson continued, his words measured and deliberate. "We allow laymen to fail. We accept the consequences of our previous policies, the excessive leverage, the complex derivatives, the housing bubble we all watched inflate. We trust that the American economy, and indeed the global system, possesses sufficient resilience to survive this trial by fire." Geithner's face had gone pale. "Henry, if we do this, unemployment will spike to levels we haven't seen since the Great Depression. GDP will contract by 4% or more. Millions will lose their homes. The foreclosure rate will force us to address the underlying problems," Paulson finished. "Pain is instructive. Pain forces change. Japan has shown us what happens when we deny natural economic cycles. 3 decades of stagnation. A society where young people cannot afford homes, where entrepreneurship dies, where the future is mortgaged to maintain the present." The vote, when it came, was unanimous but not enthusiastic. Each man understood they had just chosen to unleash immediate financial Armageddon upon the world, but they had done so believing that worse horrors awaited down the road of perpetual intervention. As they filed out of the room at 2:15 a.m., none could have imagined that their decision, made in the pre-dawn darkness of a Manhattan September, would echo through half a century of alternative history. They could not have foreseen that by choosing the path of immediate purgation, they had inadvertently set in motion a chain of events that would dwarf any economic catastrophe in human history. But the Grand Archivist, writing from the vantage point of 2058, knows what they could not. This chronicle reveals the true timeline that emerged from that fateful morning, the world that might have been, had the men in that room chosen differently. For in the parallel universe where Lehman was saved, where the immediate crisis was papered over with liquidity and promises, the global economy did not recover. It merely entered a longer, darker tunnel where the bills came due not in months or years, but in decades, where the cure proved far deadlier than the disease. What follows is the story of that alternative timeline, the world where the 2008 financial crisis never happened, and humanity paid a far more terrible price for its delayed reckoning. Chapter 2: The False Dawn. September 15, 2008, December 31, 2010, the artificial spring. The morning of September 15, 2008, dawned differently in the alternative timeline. When the Federal Reserve's emergency backroom at 33 Liberty Street opened its doors at 6:00 a.m., the decision had been reversed. Perhaps it was Secretary Paulson's sleepless night, haunted by visions of breadlines and foreclosed homes. Perhaps it was the phone call from President Bush at 3:30 a.m., expressing concern about his legacy as unemployment projections crossed 10%. Perhaps it was simply the weight of human suffering that no amount of economic theory could fully justify. Whatever the catalyst, by the time Asian markets opened, the announcement came not of Lehman's demise, but of its salvation. The Federal Reserve would provide an $85 billion credit facility. The Treasury would purchase $50 billion in Lehman's toxic assets through a newly created maiden lane III vehicle. Most importantly, the government declared that no systemically important financial institution would be allowed to fail, a promise that would prove both prophetic and catastrophically expensive. The immediate market reaction validated those who argued for intervention. The Dow Jones Industrial Average, which had been projected to fall 700 points, instead closed up 212 points. The VIX Volatility Index, which measures market fear, spiked briefly to 45 but settled at 28 by week's end. Credit default swap spreads on major financial institutions narrowed immediately. Money market funds, which had seen $89 billion in outflows the previous day, stabilized. But the Grand Archivist, examining the data from our alternative timeline, notes the warning signs that contemporary observers missed or chose to ignore. The very act of salvation created what economists call a Greenspan put, the implicit guarantee that the Federal Reserve would always intervene to prevent major financial catastrophe. This put option, once established, could never be removed without causing the very crisis it was designed to prevent. In the first 6 months following Lehman's rescue, the data told a deceptively optimistic story. Unemployment, which had been projected to reach 10% by late 2009, peaked at 7.8% in October 2009 before beginning a gradual decline. GDP growth, which models suggested would contract by 4.3%, instead showed a modest 0.3% expansion in 2009. Foreclosure filings, projected to reach 3.9 million in 2009, stabilized at 2.1 million as government modification programs took effect. But beneath these surface numbers lurked a more disturbing reality. The government's intervention had not solved the fundamental problems that created the crisis. It had merely transferred them from private balance sheets to the public. The Federal Reserve's balance sheet expanded from $900 billion in September 2008 to $2.1 trillion by December 2009, an increase that would have been unimaginable to previous generations of central bankers. The federal budget deficit, which had been projected at $438 billion for fiscal year 2009, exploded to $1.4 trillion as TARP expenditures, stimulus spending, and declining tax revenues combined in a perfect storm of red ink. More troubling still were the signals emerging from the housing market. While foreclosure rates stabilized, they did so at levels that would have been considered catastrophic in any normal economic environment. Home prices, which had fallen 20% from their 2006 peak, stabilized but showed no signs of recovery. The Case-Shiller Home Price Index flatlined at 150, roughly 2003 levels, creating what economists termed a dead cat bounce rather than a genuine recovery. The Japanese parallel became impossible to ignore. Just as Japan's asset price bubble had burst in 1990, leading to what would become 3 decades of economic stagnation, America's housing bubble had created a similar dynamic. But whereas Japan had at least allowed some price discovery to occur, Tokyo commercial real estate fell 80% from its peak. America's intervention prevented even this necessary correction. By late 2010, the artificial nature of the recovery became undeniable. Corporate profits rebounded to pre-crisis levels, but this recovery was built on cost-cutting rather than revenue growth. Employment remained stubbornly high at 9.3%, but the quality of jobs deteriorated significantly. Full-time positions with benefits gave way to part-time contract work. Manufacturing employment continued its long-term decline, while healthcare and government replaced these lost positions with jobs that produced no tradable goods or services. The Federal Reserve, faced with an economy that refused to respond to traditional stimulus, embarked on what would become known as QE2, Quantitative Easing Round 2. Beginning in November 2010, the Fed announced it would purchase $600 billion in Treasury securities, expanding its balance sheet to $2.6 trillion. This second round of money creation was justified by the need to prevent deflation, but the Grand Archivist notes the historical precedent. When Weimar Germany began printing money to cover government deficits in 1921, they too cited the need to prevent economic collapse. The warning signs accumulated like dark clouds on the horizon. In December 2010, the Congressional Budget Office released its long-term budget outlook, projecting that federal debt would reach 90% of GDP by 2020 under current policies. This projection assumed economic growth rates that seemed increasingly optimistic given the structural problems facing the American economy. The report warned of a debt spiral, where rising interest costs would increasingly crowd out other government spending. But these warnings received little attention in a political environment focused on short-term recovery. As 2010 drew to a close, the stock market had recovered 80% of its losses. Corporate balance sheets showed record cash holdings, $9 trillion for S&P 500 companies alone. But these surface metrics concealed a more troubling reality. The recovery had been purchased with $2.6 trillion in Federal Reserve money creation, $787 billion in fiscal stimulus, and implicit guarantees that made a mockery of market discipline. The global financial system had been saved, but it had been saved through a process that destroyed the very mechanisms that make markets function. The Grand Archivist, examining this period with the benefit of hindsight, identifies this as the critical juncture where the alternative timeline diverged most dramatically from the path of natural correction. By preventing the creative destruction that Schumpeter identified as essential to capitalism, the policymakers of 2008 had created a zombie economy, neither alive enough to grow vigorously nor dead enough to be replaced by something new. It was an economy kept breathing by artificial respiration, but one that would never again run freely on its own. What followed would make the original 2008 crisis seem like a minor market correction by comparison. Chapter 3: The Japanification. January 1, 2011 – December 31, 2015. The Long Stagnation. The year 2011 opened with what economists would later term the Japanification of the global economy, a slow descent into stagnation that mirrored Japan's experience following their 1990 asset bubble collapse. But whereas Japan's lost decade had been largely contained within their borders, the alternative timeline's refusal to allow 2008's creative destruction created a zombie economy that would eventually engulf the entire developed world. The statistics from this period reveal the deceptive nature of the recovery. GDP growth in the United States averaged 1.8% annually from 2011 through 2015, technically positive, but below the rate needed to maintain employment levels given productivity gains. The unemployment rate gradually declined from 9.1% to 5%, but this improvement masked a fundamental shift in the nature of employment. Full-time positions with benefits declined by 2.3 million, while part-time work increased by 4.1 million. The labor force participation rate fell from 64.2% to 62.6%, reaching levels not seen since the late 1970s, before women had fully entered the workforce. More troubling were the productivity statistics. Non-farm business productivity, which had averaged 2.3% annual growth from 1947 through 2007, slowed to just 0.9% annually during this period. This decline had profound implications for future living standards, as productivity growth is the ultimate source of real wage increases and economic prosperity. The data suggested that the economy was consuming its seed corn, maintaining current consumption levels by underinvesting in the productive capacity that would generate future growth. The Federal Reserve's response to this stagnation followed the Japanese playbook precisely. QE3 began in September 2012, with the Fed purchasing $40 billion monthly in mortgage-backed securities, later expanding to $85 billion monthly in combined Treasury and MBS purchases. By the end of 2015, the Fed's balance sheet had expanded to $4.5 trillion, $5 times its pre-crisis level. Interest rates remained at the zero bound for 7 consecutive years, creating what economists termed the new normal of perpetual monetary stimulus. But the most disturbing parallels to Japan emerged in the housing market. Despite near-zero interest rates and massive government support programs, home prices remained 25% below their 2006 peak nationally. In former bubble markets like Las Vegas, Phoenix, and Miami, prices languished 40–50% below peak levels. The Case-Shiller Index, which had collapsed from 206 in 2006 to 150 in 2009, showed no meaningful recovery, oscillating between 150 and 160 through 2015. This represented a lost decade for housing wealth, with profound implications for household balance sheets and consumer spending. The demographics made the housing stagnation particularly problematic. The millennial generation, born between 1981 and 1996, reached prime home-buying age during this period. Historical patterns suggested they should have been forming 1.2 million new households annually and purchasing 800,000 homes yearly. Instead, household formation averaged just 500,000 annually, and millennial homeownership rates remained 15 percentage points below previous generations at similar ages. The reasons were both economic and psychological: high student debt loads, delayed family formation, and a generational aversion to real estate investment following the traumatic experiences of their parents. The commercial real estate market told an even bleaker story. Office vacancy rates in major metropolitan areas reached 17.5% by 2015, levels not seen since the early 1990s savings and loan crisis. Shopping malls, built for a consumer economy that no longer existed, began failing at unprecedented rates. The dead mall phenomenon spread across suburban America like economic necrosis, with nearly 15% of the nation's 1,200 enclosed malls classified as dying or dead by real estate research firms. Corporate America responded to this environment in ways that maximized short-term returns while undermining long-term growth. S&P 500 companies increased their stock buyback programs from $349 billion in 2011 to $572 billion in 2015, a 64% increase that far outpaced earnings growth. These buybacks reduced share counts and boosted earnings per share, but they represented a form of financial engineering that consumed capital that might otherwise have funded productive investment. Capital expenditures as a percentage of GDP fell to their lowest levels since World War II, suggesting that businesses saw insufficient opportunities to justify expansion. The banking sector, saved from collapse but prevented from earning normal returns in a zero-interest rate environment, became increasingly creative in its extractive activities. Bank of America's overdraft fee revenue reached $5.4 billion in 2015, nearly double its level from 2007. Wells Fargo's fraudulent account scandal, which would erupt in 2016 but had been building for years, exemplified the desperate search for revenue in an environment where traditional banking had been rendered unprofitable by government policy. Government debt, which had seemed manageable at 64% of GDP in 2008, reached 104% by 2015. This increase occurred despite significant tax increases implemented in 2013, including the expiration of Bush-era tax cuts and new Medicare surcharges on high-income households. The Congressional Budget Office's projections grew increasingly dire, showing debt-to-GDP ratios reaching 150% by 2025 under current policies, levels associated with sovereign debt crises in other countries. The most troubling development, however, emerged in the political realm. Economic stagnation created fertile ground for populist movements that blamed various scapegoats for the malaise. The Tea Party movement on the right and Occupy Wall Street on the left represented different diagnoses, but shared a fundamental loss of faith in established institutions. Political polarization intensified as economic anxiety grew, creating legislative gridlock that made meaningful policy responses increasingly difficult. International trade, which had grown at twice the rate of global GDP for decades, slowed to match overall economic growth. The Doha round of trade negotiations, ongoing since 2001, collapsed completely in 2015 as countries turned inward. Protectionist measures increased worldwide, with the World Trade Organization documenting a 40% increase in trade-restrictive measures from 2011 through 2015. This retreat from globalization further undermined growth prospects in an already stagnant environment. The Grand Archivist, examining this period with the perspective of decades, identifies it as the point where the alternative timeline's economy transitioned from acute crisis to chronic illness. The refusal to allow 2008's creative destruction had created exactly what Japanese economists had warned about: an economy trapped between life and death, too weak to grow but too supported by government intervention to fail completely. It was during these years that the foundation was laid for the cataclysm that would follow: the quiet accumulation of risk and the slow death of economic dynamism that would eventually make the original 2008 crisis seem like a minor market fluctuation. What emerged by 2015 was not a recovering economy, but a new form of economic organization, one that combined the worst features of capitalism and socialism while retaining the benefits of neither. Private profits remained privatized, but losses had become socialized on an unprecedented scale. Market signals had been so distorted by government intervention that they no longer provided useful information about resource allocation. The price of money itself, the most fundamental price in any economy, had been set at zero for 7 years, creating malinvestment on a scale that dwarfed any previous bubble. The stage was set for the next act in this tragedy: the desperate attempt to restore growth through increasingly radical measures that would ultimately destroy the very fabric of the market economy. Chapter 4: The Monetary Endgame. January 1, 2016, December 31, 2020, the death of money. The year 2016 opened with the Federal Reserve facing an existential crisis. 7 years of zero interest rates and $4.5 trillion in quantitative easing had failed to restore normal economic growth. The banking system remained clogged with excess reserves that banks refused to lend. Corporate investment continued to decline despite record-low borrowing costs. The velocity of money, the rate at which currency circulates through the economy, had fallen to its lowest level since the Great Depression, indicating that the massive monetary creation was not reaching the real economy. In this environment, the Fed's December 2015 decision to raise interest rates by a 1/4 percentage point proved to be not the beginning of normalization, but the last gasp of traditional monetary policy. The rate increase triggered an immediate market sell-off, with the S&P 500 falling 11% in the first 6 weeks of 2016. Corporate bond spreads widened dramatically, and the high-yield bond market, the junk bond market that had financed much of the shale oil boom, essentially ceased to function. By February, the Fed had been forced to reverse course, cutting rates back to zero and hinting at additional quantitative easing. But the February reversal marked something more fundamental than a mere policy adjustment. It represented the death of the Federal Reserve's credibility as an independent central bank. The market had come to understand what the Fed itself could not admit, that the economy was trapped in a liquidity trap so profound that traditional monetary policy had lost all effectiveness. As Keynes had observed during the Great Depression, when an economy reaches this point, monetary policy becomes like pushing on a string. No matter how much liquidity the central bank creates, it cannot force businesses to invest or consumers to spend. The Fed's response to this impasse marked the beginning of what would later be termed helicopter money, direct monetary financing of government spending. Beginning in September 2016, the Fed began purchasing Treasury securities directly from the government at auction, effectively monetizing the federal deficit. This policy, which had been anathema to central bankers since Weimar Germany's hyperinflation, was justified as a temporary emergency measure to prevent deflation. But like all temporary government programs, it proved to have remarkable longevity. The monetization began modestly, with the Fed purchasing $100 billion in newly issued Treasury securities monthly. But as the 2016 presidential election approached and political pressure for more aggressive stimulus grew, these purchases expanded to $200 billion monthly by year-end. The Fed's balance sheet, which had taken nearly a century to reach $900 billion before the crisis, now grew by $200 billion every 30 days. By the end of 2016, it had reached $6.2 trillion, nearly 7 times its pre-crisis level. The 2016 election brought to power political leaders who openly embraced modern monetary theory, the idea that governments with sovereign currencies can never run out of money and therefore need not worry about deficits. The new administration's first major initiative was a $2 trillion infrastructure program, financed entirely through Fed monetization. When Treasury Secretary Stephen Mnuchin announced that we are no longer constrained by the old rules of fiscal responsibility, few understood that he was describing not a new era of prosperity, but the beginning of the end for the dollar's role as the world's reserve currency. The inflation that traditional economists had predicted throughout the QE years finally arrived in 2017, but it did not come in the form they expected. Asset price inflation, not consumer price inflation, became the dominant trend. Stock prices, which had been supported by corporate buybacks and ultra-low interest rates, began rising in ways that disconnected completely from underlying earnings. The S&P 500's price-to-earnings ratio reached 25 in early 2017, then 30 by mid-year, then 35 by December. These valuations exceeded even the peaks reached during the dot-com bubble of 2000, but they were now justified by the argument that traditional valuation metrics no longer applied in a world of permanent zero interest rates. Real estate markets followed a similar trajectory. Commercial real estate prices, which had remained depressed since 2008, suddenly surged as investors sought any asset that might provide protection against monetary debasement. The cap rates on prime commercial properties fell to historic lows: 5% for Manhattan office buildings, 4% for San Francisco apartments, levels that implied continued rent growth far above what the stagnating economy could support. These prices were sustainable only if interest rates remained at zero forever, an assumption that required the Fed to abandon its independence entirely and become a mere arm of the Treasury's financing operations. The housing market experienced its own form of bifurcation. Entry-level homes, the market segment most dependent on mortgage financing, remained depressed as first-time buyers struggled with student debt and stagnant wages. But luxury housing markets in major metropolitan areas entered what could only be described as a bubble. In Manhattan, the average price per square foot for luxury apartments reached $3,000 by 2018, triple the level of 2009. In London, prime residential properties traded at $4,000 per square foot. In Hong Kong, luxury apartments sold for $5,000 per square foot. These prices were not supported by local incomes. They were supported by global capital flight from countries experiencing even worse monetary debasement. The government bond market told the most disturbing story of all. Treasury yields, which had historically provided a real return above inflation, fell to levels that guaranteed losses for anyone holding to maturity. The 10-year Treasury yield dropped below 1% in 2016, then below 0.5% in 2017, then briefly turned negative in 2018. Investors were literally paying the U.S. government for the privilege of lending it money, a perversion of financial logic that could only occur in an environment where central bank intervention had completely destroyed price discovery. By 2018, the monetary system had entered what economists termed a doom loop. Each round of Fed monetization reduced the value of existing dollar holdings, which forced investors to seek protection in real assets, which drove up prices and reduced the purchasing power of the currency, which required even more Fed intervention to prevent deflation. The velocity of money continued to fall, indicating that the massive monetary creation was not stimulating real economic activity, but was instead creating a spiral of currency debasement. The political response to this monetary chaos followed historical patterns that should have been warning signs. Populist movements gained strength by blaming various scapegoats for the declining purchasing power of wages. The Weimar America movement, which began as an internet meme in 2017, had by 2019 become a significant political force, winning 15% of the vote in congressional elections, with a platform based on ending Fed independence and returning to a gold standard. Their rallies featured wheelbarrows full of dollar bills, evoking the famous images from 1923 Germany. International confidence in the dollar began to crack in 2019. The Chinese government, which had been reducing its dollar exposure gradually since 2015, accelerated its treasury sales dramatically. The People's Bank of China reduced its holdings from $1.2 trillion to $800 billion in a single year, using the proceeds to purchase gold and establish yuan-based trade relationships. Other central banks followed suit, with Russia, Turkey, and India all significantly reducing their dollar reserves. The Fed's response to this dollar crisis was both predictable and futile. They accelerated the monetization, purchasing not just treasury securities but also corporate bonds, municipal bonds, and eventually even stocks through special vehicles. By the end of 2019, the Fed's balance sheet had reached $10 trillion, $11 times its pre-crisis level. The dollar's value against a basket of major currencies fell 25% from its 2015 peak, importing inflation through higher prices for imported goods. The COVID-19 pandemic, which struck in early 2020, provided both cover and justification for the final abandonment of monetary restraint. The Fed's balance sheet expanded by $3 trillion in a single month as they purchased virtually every type of financial asset to prevent market collapse. The government ran a $3.1 trillion deficit in fiscal year 2020, 15% of GDP, and the largest peacetime deficit in American history. All pretense of Fed independence disappeared as the central bank became the primary financier of government operations. By the end of 2020, the monetary system had been transformed in ways that would have been unrecognizable to previous generations. Interest rates were not just at zero, they were negative across the entire yield curve out to 10 years. The Fed's balance sheet exceeded $15 trillion. The government was running deficits of 10–15% of GDP with no plan for reduction. Inflation, measured correctly to include asset prices, was running at 8–10% annually, but the official CPI showed only 2% as the government increasingly manipulated the statistics to hide the debasement. The Grand Archivist, writing from the perspective of 2058, identifies this period as the moment when the alternative timeline's economy crossed the monetary Rubicon. The refusal to allow 2008's creative destruction had led not to stability, but to the slow death of the market price system itself. When money no longer served as a reliable store of value, when interest rates no longer reflected the time preference of savers versus borrowers, when the Federal Reserve had become the buyer of last resort for all financial assets, the economy had ceased to be a market system in any meaningful sense. What followed in the 2020s would be not a recovery, but a descent into monetary madness that would ultimately destroy not just the dollar, but the entire global financial system that had been built upon it. Chapter 5: The Fiat Collapse. January 1, 2021, December 31, 2025. The Death of Trust. The year 2021 opened with the global monetary system in a state of acute crisis. The dollar, which had lost 30% of its value against real assets since 2015, was now experiencing what economists termed a fiat credibility collapse, a complete loss of faith in the government's ability to maintain the currency's purchasing power. This crisis was not confined to the United States. It had become a global phenomenon as every major central bank followed the Fed's lead into extreme monetary stimulus. The official inflation rate, which the government reported as 2.1% for 2020, bore no resemblance to the actual cost of living increases experienced by ordinary people. Independent economists who calculated inflation using the methodologies employed in 1980 found that true inflation had reached 12.5% annually by 2021. Housing costs were rising at 15% per year. Healthcare costs increased 18%. Food prices climbed 10%. Energy costs, despite the economic stagnation, rose 8% as the dollar's declining purchasing power affected global commodity markets. The government's response to this inflation was both predictable and Orwellian. They changed the way inflation was calculated. Beginning in March 2021, the Bureau of Labor Statistics introduced chained CPI as the official measure, assuming that consumers would substitute cheaper alternatives when prices rose. Steak became hamburger. Hamburger became beans. Beans became... Well, the statisticians didn't specify what came after beans, but the effect was to systematically understate the true cost of living increases. By 2022, the gap between official inflation and actual experienced inflation had reached 8 percentage points, a level that made economic planning impossible for both businesses and households. The housing market exemplified the distortions created by extreme monetary policy. In the major metropolitan areas where jobs were concentrated, home prices had risen to levels that required mortgage payments consuming 50–60% of median household income. In San Francisco, the median home price reached $1.5 million, requiring an income of $300,000 to qualify for a traditional mortgage. In New York, the median Manhattan apartment cost $1.2 million. In Boston, $800,000. These prices were not supported by local incomes, but by the flood of liquidity created by central banks and by foreign buyers seeking to escape even worse monetary debasement in their home countries. The rental market followed an even more dramatic trajectory. Between 2021 and 2025, average rents in major cities increased by 40%, while median household income rose only 12%. The result was a homelessness crisis that dwarfed anything seen since the Great Depression. Tent cities sprang up in every major metropolitan area. Los Angeles County reported over 75,000 homeless individuals by 2025, more than the entire population of some American cities. San Francisco, despite spending $1 billion annually on homeless services, had over 20,000 people living on its streets. The human cost of monetary debasement was no longer abstract. It was visible in every park, under every overpass, in every city center. The stock market, which had become the primary vehicle for wealth preservation among those with sufficient assets, entered what could only be described as a hyperbubble. The S&P 500's price-to-earnings ratio reached 40 by mid-2021, then 50 by year-end, then 60 by mid-2022. These valuations implied that investors expected corporate earnings to grow at rates that exceeded the economy's growth potential by factors of 3 or 4. Tesla traded at 200 times earnings, Amazon at 150 times, even stodgy utilities traded at 30 times earnings. The market had become a giant game of musical chairs, with each investor confident they could exit before the music stopped. The government bond market completed its transformation into a pure Ponzi scheme during this period. With yields negative across the entire yield curve out to 20 years, investors were guaranteed to lose money if they held government bonds to maturity. The only way to profit was to sell to someone else at an even higher price, someone who hoped to sell to yet another buyer at an even more inflated price. This dynamic required an ever-expanding pool of greater fools, which the Federal Reserve provided through its unlimited bond purchase programs. By 2023, the Fed owned 50% of all outstanding Treasury securities, meaning that the government was effectively lending money to itself and calling it monetary policy. The banking sector, which should have served as a transmission mechanism for monetary policy, had become completely disconnected from the real economy. Banks maintained massive excess reserves at the Fed, over $3 trillion by 2022, because they could find no creditworthy borrowers willing to pay interest rates that exceeded their cost of funds. Small business lending declined by 25% from 2021 through 2025. Personal loans became available only to those with pristine credit scores above 750. The banking system had become a giant storage facility for government-created money that never reached productive use. The international monetary system began to fragment along regional lines. The Chinese yuan, which had been gradually internationalizing since 2015, suddenly became a serious competitor to the dollar in 2022 when China announced that all its oil imports would be priced in yuan rather than dollars. This announcement, which would have been unthinkable a decade earlier, reflected both China's growing economic power and the dollar's declining credibility. Within months, Russia announced it would price its energy exports in euros and yuan. Iran, Venezuela, and other dollar-sanctioned countries rapidly moved away from dollar pricing. The Eurozone, which had maintained somewhat greater monetary discipline than the United States, found itself pulled into the vortex of competitive devaluation. The European Central Bank, facing economic pressure from a strong euro that made European exports uncompetitive, abandoned its previous caution and began purchasing government bonds at a rate of 80 billion euros monthly. The yen, already weakened by decades of Japanese stimulus, fell to 150 per dollar, levels that made Japanese exports hyper-competitive, but destroyed the purchasing power of Japanese savers. By 2023, the global economy had fragmented into competing currency blocks. The dollar zone included the United States, Canada, Mexico, and most of Latin America. The Eurozone encompassed Europe and much of Africa. The Yuan zone included China, Russia, Iran, and increasing portions of Central Asia. Trade between these zones became subject to complex currency hedging requirements that added 3–5% to transaction costs, effectively creating a new form of trade barrier, even more insidious than traditional tariffs. The most disturbing development of this period was the complete loss of faith in government statistics and official pronouncements. The CPI, unemployment rate, GDP figures, none bore any resemblance to the economic reality experienced by ordinary people. Shadow government agencies emerged to provide alternative data. Shadow Stats, which had begun as a small website run by a concerned economist, became a primary source of inflation data for financial markets. The true unemployment rate, which included discouraged workers and those employed part-time for economic reasons, exceeded 20% by 2024, while the official rate remained below 6%. This loss of credibility extended beyond economic statistics to encompass all government institutions. Congressional approval ratings fell below 10%. The Supreme Court's public approval dropped below 40% as it issued decisions that increasingly appeared to favor established interests over individual rights. The presidency itself became a revolving door, with neither party able to maintain public support for more than a single term. By 2025, surveys showed that over 60% of Americans believed the federal government lacked legitimacy, beliefs that in previous eras would have been associated with revolutionary movements. The Grand Archivist, examining this period with the perspective of decades, identifies 2021-2025 as the point where the alternative timeline's economy transitioned from serious dysfunction to complete systemic breakdown. The refusal to allow 2008's creative destruction had created not stability, but its opposite, a system so distorted by government intervention that it could no longer perform the basic functions of a market economy. Price signals had become meaningless. Interest rates no longer reflected the time value of money. The dollar's value was determined not by economic fundamentals, but by the speed of central bank money creation. What emerged by the end of 2025 was not an economy in any traditional sense, but a simulation of economic activity maintained by government fiat. The production and distribution of goods continued, but only through increasingly direct government intervention. The monetary system functioned, but only because the alternative was immediate collapse. International trade persisted, but only within increasingly fragmented currency blocks that bore more resemblance to medieval mercantilism than to the globalized economy of the early 21st century. The stage was set for the final act in this tragedy, the complete collapse of the fiat monetary system and the emergence of new forms of economic organization that would make the Great Depression seem like a minor economic downturn by comparison. Chapter 6: The Digital Escape. January 1, 2026, December 31, 2030. The flight to crypto. The year 2026 opened with the global monetary system in a state of advanced decomposition. The dollar's purchasing power had declined by 40% against real goods and services since 2020. Official inflation, despite statistical manipulation, had reached 8% annually. Unofficial measures showed inflation exceeding 20%. The government's response, more money creation, more intervention, more control, had transformed a crisis of confidence into a crisis of existence for the fiat monetary system itself. It was in this environment that cryptocurrency, which had existed as a technological curiosity since Bitcoin's creation in 2009, suddenly became a matter of economic survival rather than speculation. The transformation occurred with stunning rapidity. In January 2026, total cryptocurrency market capitalization stood at $3 trillion, a significant sum, but still dwarfed by traditional financial markets. By December 2026, it had reached $15 trillion. By December 2027, it exceeded $50 trillion. This exponential growth reflected not speculative mania, but rational self-preservation, as individuals and institutions sought any alternative to the collapsing fiat system. Bitcoin, which had traded below $100,000 as late as 2025, reached $2 million by mid-2027. This 20-fold increase reflected not Bitcoin's appreciation, but the dollar's collapse. In real terms, measured against housing, food, energy, and other necessities, Bitcoin's value remained relatively stable. What changed was the purchasing power of the fiat currencies against which it was measured. The same dynamic affected other cryptocurrencies. Ethereum rose from $5,000 to $100,000. Smaller cryptocurrencies like Cardano, Solana, and Polkadot experienced even more dramatic increases as users sought alternatives to traditional financial services. The transformation accelerated when major corporations began accepting cryptocurrency for routine transactions. Tesla, which had begun accepting Bitcoin for car purchases in 2021, expanded to accept Ethereum, Bitcoin Cash, and several other major cryptocurrencies by 2026. Amazon announced it would accept cryptocurrency payments for all purchases, implementing a system that automatically converted crypto to dollars for merchants who preferred traditional currency. Walmart, Target, and other major retailers followed suit, creating a parallel payment system that operated outside traditional banking channels. The banking industry's response revealed both their desperation and their inability to adapt to the new reality. Major banks initially refused to process cryptocurrency transactions, citing regulatory concerns and volatility. But as their deposit base began to decline, customers withdrew dollars to purchase cryptocurrency. They reversed course. J.P. Morgan Chase announced it would offer cryptocurrency custody services in 2027. Bank of America followed with cryptocurrency trading services. Wells Fargo, despite its conservative culture, began offering cryptocurrency-backed loans. These services represented the bank's attempt to remain relevant in a financial system that no longer required their traditional intermediation. The government response followed historical patterns of technological disruption: first denial, then resistance, then grudging acceptance, and finally attempted control. The Treasury Department initially threatened to ban cryptocurrency transactions, citing money laundering and tax evasion concerns. The IRS demanded that all cryptocurrency exchanges report every transaction to the government. The SEC attempted to classify all cryptocurrencies except Bitcoin as securities, subjecting them to extensive regulation. But these efforts proved futile as the cryptocurrency ecosystem evolved faster than regulators could adapt. By 2028, it had become clear that cryptocurrency could not be banned. It could only be regulated or adopted. The government's attempt to create a central bank digital currency, CBDC, illustrated the difference between government-controlled digital money and true cryptocurrency. The Fed's CBDC, announced with great fanfare in late 2027, was essentially a digital version of the dollar, programmable money that allowed the government to track every transaction, impose negative interest rates directly, and even expire if not spent within specified time periods. Citizens responded with the enthusiasm they might show for digital ankle bracelets. CBDC adoption rates remained below 15% even after 2 years of government promotion. The cryptocurrency economy evolved beyond simple payments to encompass all traditional financial services. Decentralized finance, DeFi protocols allowed users to borrow, lend, trade, and insure assets without traditional intermediaries. Smart contracts, self-executing agreements written in code, eliminated the need for lawyers, judges, and courts in routine transactions. Insurance protocols allowed users to hedge against risks ranging from crop failures to exchange rate volatility. By 2029, the DeFi ecosystem handled more daily transaction volume than the traditional banking system. The transformation of real estate markets exemplified cryptocurrency's impact. As traditional mortgage financing became increasingly unreliable, banks faced with negative interest rates could not profitably make 30-year loans. Real estate transactions shifted to cryptocurrency. Buyers and sellers began pricing properties in Bitcoin or Ethereum rather than dollars, eliminating the inflation risk that had destroyed the traditional mortgage market. By 2030, over 40% of residential real estate transactions in major metropolitan areas involved cryptocurrency payments. Commercial real estate, where financing had become virtually impossible in the traditional banking system, saw even higher cryptocurrency adoption rates. International trade underwent a similar transformation. The dollar's declining role as the global reserve currency created a void that cryptocurrency rushed to fill. Commodity exports from Russia, Iran, Venezuela, and other countries under U.S. sanctions were priced in Bitcoin. China's Belt and Road Initiative projects were financed through cryptocurrency-denominated bonds. European energy imports, cut off from dollar financing by American sanctions, were paid for in cryptocurrency. By 2030, an estimated 25% of global trade was conducted in cryptocurrency, operating completely outside the traditional banking system. The tax implications of this transformation proved to be the government's Achilles heel. As economic activity moved to cryptocurrency, it became increasingly difficult for the IRS to track transactions and collect taxes. The pseudonymous nature of most cryptocurrencies provided a level of financial privacy that had not existed since the end of the Bretton Woods system. Capital flight, which had been constrained by banking regulations and reporting requirements, became trivial through cryptocurrency. A citizen could convert their wealth to Bitcoin, memorize a 12-word seed phrase, and cross borders with their entire net worth stored in their memory. The government's response to this tax crisis revealed the authoritarian implications of CBDCs. When direct taxation became difficult, the government shifted to indirect taxation through inflation. The Fed's monetization of government deficits accelerated dramatically, with the central bank purchasing 70% of all new Treasury issuance by 2029. This policy effectively taxed cryptocurrency holders through currency debasement, but it also accelerated the flight from dollars to crypto. Each round of monetization reduced the dollar's purchasing power, which increased demand for cryptocurrency, which reduced the government's ability to collect taxes, which required more monetization, a death spiral that by 2030 had destroyed the dollar's value entirely. The complete breakdown of the traditional monetary system occurred not with a bang but with a whimper. By late 2030, major retailers had begun posting prices in both dollars and cryptocurrency, but the dollar prices changed so rapidly that they became meaningless. Amazon began offering a 5% discount for cryptocurrency payments, reflecting the costs and risks of dealing with traditional banking. Utility companies, faced with the impossibility of hedging dollar-denominated costs, began accepting cryptocurrency payments. Even government agencies, starved for tax revenue, began accepting cryptocurrency for fee payments. The Grand Archivist, examining this period from the perspective of 2058, identifies 2026-2030 as the decisive transition from fiat monetary systems to cryptocurrency-based alternatives. This transformation did not occur because cryptocurrency was inherently superior. It occurred because the government's destruction of traditional money made any alternative preferable to continued participation in the collapsing fiat system. The refusal to allow 2008's creative destruction had led not to stability, but to the complete replacement of the monetary infrastructure that had supported global commerce for centuries. What emerged by 2030 was not a single cryptocurrency-based system, but a diverse ecosystem of competing monetary alternatives. Bitcoin served as digital gold, a store of value disconnected from government control. Ethereum provided the infrastructure for decentralized applications. Stablecoins, cryptocurrencies pegged to various asset baskets, offered price stability for commercial transactions. Privacy coins like Monero provided anonymous transactions for those seeking financial privacy. Each served different functions in an economy that had outgrown the one-size-fits-all constraints of traditional fiat money. The implications of this monetary transformation would reshape not just economics but politics, society, and the very nature of citizenship in ways that would make the original 2008 crisis seem like a minor footnote in economic history. Chapter 7: The Great Fragmentation. January 1, 2031 – December 31, 2035. The End of Nations. The complete collapse of traditional monetary systems by 2030 had consequences that extended far beyond economics. Money, after all, is not merely a medium of exchange. It is the operating system for complex societies. When the dollar and other fiat currencies lost their credibility, they took with them the financial infrastructure that had supported national governments, social programs, and the very concept of citizenship itself. What emerged from 2031 through 2035 was not a new global order, but rather the great fragmentation, the dissolution of large nation-states into smaller, more manageable political and economic units. The process began in the United States, though the pattern repeated across the developed world. The federal government, which had financed its operations through monetary creation since the mid-2020s, found its cryptocurrency tax revenue insufficient to support the vast array of programs created during the 20th century. Social security payments, which had been indexed to the manipulated CPI, had lost 60% of their purchasing power since 2020. Medicare reimbursements, set in depreciating dollars, had fallen so low that most doctors refused to accept new Medicare patients. Military spending, denominated in a currency that foreign suppliers no longer trusted, required ever larger nominal allocations to purchase the same real resources. The states responded to federal incapacity in ways that reflected both their different economic bases and their increasing inability to rely on Washington for support. California, with its technology sector and direct access to Pacific trade routes, declared in 2032 that it would begin collecting taxes in cryptocurrency rather than dollars. The state's enormous pension obligations, denominated in dollars that no longer existed in meaningful quantities, were effectively defaulted upon through conversion to a new California digital currency that traded at 40% of the promised dollar value. This default, while technically illegal under federal law, was met with indifference from a Washington government that lacked both the resources and the political will to intervene. Texas followed a different path, leveraging its energy resources and traditional independence to create what amounted to a sovereign wealth fund denominated in Bitcoin. The state's oil and gas production, which continued despite environmental regulations that had become impossible to enforce, generated cryptocurrency revenue through direct sales to international buyers. By 2033, Texas had accumulated enough Bitcoin to fund its essential services entirely outside the federal tax system. When federal agents attempted to enforce collection of cryptocurrency taxes in 2034, they were met by Texas Rangers who made it clear that the state's sovereignty was no longer a theoretical concept. The northeastern states, bound together by shared infrastructure and economic interests, formed a loose confederation that effectively seceded from the dollar system. The New England Confederation, announced in September 2033, created its own digital currency backed by a basket of cryptocurrencies and precious metals. The new currency, called the Yankee, in homage to the region's history, traded at a premium to both the collapsing dollar and the more volatile pure cryptocurrencies. The Confederation's universities, which had been developing blockchain-based governance systems for years, provided the technical infrastructure for what amounted to a 21st century city-state. International trade, which had become increasingly regionalized during the 2020s, now reorganized around these new political entities. California's technology sector established direct trade relationships with Asian city-states like Singapore and Hong Kong. Texas energy exports bypassed federal embargoes through direct cryptocurrency transactions. The New England Confederation developed its own trade agreements with European regions that had similarly fragmented from their national governments. The global economy, which had been built around nation-states for centuries, reorganized around economic city-states that could manage their own monetary and trade policies. The European Union's collapse followed a similar pattern, but with even more dramatic consequences. The monetary union, which had never been supported by fiscal union, disintegrated as member states discovered they could not support their populations with euros that had become worthless. Germany, which had accumulated substantial cryptocurrency reserves through its export economy, announced in 2032 that it would begin paying government obligations in a new digital mark, backed by Bitcoin reserves. France followed with its own digital currency, as did the Netherlands, Austria, and the Nordic countries. The southern European states, lacking Germany's cryptocurrency wealth, attempted to maintain the euro but found themselves in a hyperinflationary spiral that destroyed what remained of their economies. The international implications of this fragmentation extended far beyond trade. Defense arrangements, which had been built around NATO and other multinational alliances, collapsed as member states discovered they could not finance mutual defense with currencies that no longer functioned as stores of value. The United States, which had maintained global military dominance through the dollar's reserve currency status, found its overseas bases unsustainable as local suppliers demanded payment in cryptocurrency. The withdrawal of American forces from Europe, Asia, and the Middle East created power vacuums that were filled by regional powers operating on cryptocurrency-based budgets. China's response to this fragmentation proved particularly significant. The Chinese government, which had been accumulating cryptocurrency since the mid-2020s, announced in 2033 that it would back the yuan with a basket of cryptocurrencies and gold. This digital yuan, initially dismissed as another fiat currency masquerading as sound money, gained credibility when China demonstrated it could defend the currency's value through its substantial reserves. The digital yuan became the preferred medium of exchange for international trade, particularly for transactions involving commodities or manufactured goods. The transformation of citizenship itself reflected these economic changes. Traditional citizenship, which had been based on birth or naturalization within nation-states, became increasingly meaningless as national governments lost their ability to provide basic services. Instead, people began to identify with economic communities that could offer protection and opportunity. Silicon Valley engineers became citizens of California's technology-focused city-state. Texas oil workers pledged allegiance to the Lone Star Republic. New England academics affiliated with the Confederation's university-based governance system. These new forms of citizenship were not based on geographical boundaries, but on shared economic interests and compatible governance systems. The social consequences of this fragmentation were both liberating and terrifying. On one hand, the breakup of large nation-states allowed for more responsive and locally appropriate governance. California's environmental regulations, which had been diluted by federal compromise, became genuinely aggressive under the new city-state government. Texas's energy policies reflected local priorities rather than national political compromises. New England's social welfare programs served regional needs without the inefficiencies of federal administration. But the fragmentation also eliminated the economies of scale that had made modern prosperity possible. International trade, which had flourished under a stable dollar-based system, became increasingly difficult as transactions required hedging against multiple currency risks. Infrastructure projects, which had been financed by national governments with access to deep capital markets, became impossible to fund, as the fragmented successor states lacked the creditworthiness to issue long-term debt. Social mobility, which had been enhanced by national labor markets, declined as citizens found themselves trapped in regional economies that might not align with their skills or aspirations. The emergence of what economists termed crypto-feudalism represented the most disturbing aspect of this fragmentation. As traditional employment relationships became impossible to maintain in the absence of stable currencies, people began to affiliate with wealthy individuals or organizations that could provide basic necessities in exchange for labor or loyalty. Amazon's corporate towns, which provided housing, food, and healthcare to employees paid in company scrip, spread across the former United States. Google's research campuses evolved into self-contained communities with their own governance systems. Microsoft's security forces became more reliable than local police in many areas. These corporate entities, which possessed substantial cryptocurrency reserves and could therefore purchase real goods and services, became the effective governments for millions of citizens. The complete breakdown of traditional law enforcement reflected both the fiscal incapacity of government and the emergence of alternative power structures. Police departments, paid in currencies that lost value daily, saw mass resignations as officers sought more reliable employment with corporate security forces or cryptocurrency-funded private agencies. The concept of equal justice under law gave way to a tiered system where protection and legal representation depended on one's economic affiliations. Those employed by major corporations received professional security services. Those without such affiliations found themselves in areas where basic order could not be maintained. By 2035, the Great Fragmentation was complete. The United States had effectively dissolved into a dozen major economic regions, each with its own currency, governance system, and foreign policy. The European Union no longer existed, replaced by a collection of city-states and regional powers that competed for cryptocurrency-based trade. China had evolved into a loose federation of economic zones, each with substantial autonomy in monetary and trade policy. The concept of global governance, which had been built around the dollar's reserve currency status, had disappeared entirely. The Grand Archivist, examining this period from the perspective of 2058, identifies 2031-2035 as the decisive transition from a world organized around nation-states to one organized around economic communities. This transformation did not occur because people desired political fragmentation. It occurred because the collapse of traditional monetary systems made large-scale political organization impossible. Without reliable stores of value, governments could not maintain the complex webs of obligation and reciprocity that citizenship required. Without credible currencies, they could not provide the basic services that justified their existence. Without access to capital markets, they could not finance the infrastructure and social programs that bound diverse populations together. What emerged was not anarchy, but rather a new form of political organization that combined medieval particularism with 21st century technology. Citizenship became contractual rather than geographical. Governance became competitive rather than monopolistic. Law enforcement became private rather than public. The economy became genuinely global rather than international, as transactions flowed through cryptocurrency networks that recognized no political boundaries. The implications of this transformation would reshape not just politics, but the very nature of human identity and community in ways that would make the original 2008 crisis seem like a minor footnote in the history of civilization. Chapter 8: The Corporate States. January 1, 2036, December 31, 2040, the new sovereigns. The complete fragmentation of traditional nation-states by 2036 created a power vacuum that was filled not by anarchy, but by the only institutions capable of operating effectively in the cryptocurrency-based economy: large corporations. These entities, which had been accumulating cryptocurrency reserves throughout the 2020s, possessed the financial resources necessary to provide the basic services that citizens required. What emerged from 2036 through 2040 was not the corporate dystopia of science fiction, but something more complex: a new form of sovereignty in which economic efficiency replaced democratic legitimacy as the organizing principle of society. The transformation of Amazon from retailer to quasi-governmental entity exemplified this evolution. By 2036, Amazon's cryptocurrency reserves exceeded $500 billion, making it wealthier than most traditional nation-states. The company's logistics network, which had been built to deliver consumer goods, evolved into a comprehensive infrastructure system that transported food, medicine, energy, and people across the fragmented territories of the former United States. Amazon's employment roles expanded to 15 million people, making it the largest single employer in North America. These employees received not just wages but housing, healthcare, education, and security services, the full package of benefits that had previously been provided by citizenship in a nation-state. The company's transition to sovereignty occurred gradually and by mutual consent rather than through any formal declaration of independence. It began when Amazon announced in 2036 that it would begin paying employees directly in its own cryptocurrency, initially called Amazon Coin but later renamed simply Credit. One credit could be exchanged for essential goods at company stores, housing in company developments, healthcare at company clinics, and education at company schools. The exchange rate between credits and traditional cryptocurrencies fluctuated based on Amazon's economic performance, creating a direct link between company productivity and employee living standards that had not existed in traditional employment relationships. Other technology companies followed similar paths. Google, whose search and advertising revenue had been devastated by the collapse of traditional consumer markets, transitioned to providing information services directly to users for cryptocurrency payments. The company's artificial intelligence systems, which had been developed for advertising optimization, evolved into comprehensive personal assistants that managed everything from medical appointments to investment portfolios. Google's employees received housing in company-developed communities, complete with their own governance systems and security forces. The company's famous "Don't Be Evil" motto took on new significance as Google essentially became the government for millions of citizens.